Hello and welcome to this video about absorption costing and variable costing. I'm going to get right to it. There are two ways to try and understand the costs of your company in the income statement. Okay, so let's go ahead quickly with absorption costing. Let's see, there we go. So basically, you want to find out what the cost of goods sold is, and the cost of goods sold can also be said as your beginning inventory plus your cost of good manufactured minus your ending inventory, right? So the ways to compute this is try and find out how do we get the cost of goods manufactured, and they're different in the two costing systems. In variable costing, the cost of goods manufactured is equal to your variable manufacturing costs, of course, plus your fixed manufacturing costs. Okay? Now, this includes then your direct materials, your direct labor, your variable overheads, and your fixed overheads. And the fixed overheads is what is different in absorption costing and in variable costing. Because in absorption costing, they're actually product costs, and in variable costing, they are period costs, which means that in variable cost, they are expensed immediately, whereas in absorption costing, they're only expensed when it's sold. So it goes into assets if it's not sold, which is why we get different results in our income statements. For example, when we have different level of productions and different level of sales, right? So I should probably write that down here in blue. I can write that in blue. That absorption costing, right? When is you could say greater, the net income is greater than variable costing when the production is greater than sales. And for variable costing, sorry, there we go, just so it all makes sense, is greater than absorption costing when sales are greater than production, right? Good. So now that we have that understood, let's go back. Now, as I said earlier, non-manufacturing costs are period costs. And when we talk about absorption costing, we talk about gross margin on the income statement. Whereas for variable costing, we are actually talking about the contribution margin, which you already have seen from the other videos. It is your sales minus your variable costs, right? And this actually also gives us the formula that we use, which that the cost of goods manufactured is just your variable manufacturing costs. And if you want to expand that further, then you could say that it's your direct materials plus your direct labor. Of course, direct labor is seen as a variable cost, and your variable overheads. So just to make everything a bit more clear, in the gross margin, right, we have your variable period costs included, which are not included in your variable costing. And in the contribution margin, we actually have fixed product costs. Now, this part, of course, sounds a bit weird, so let me show you this graph. So it all makes sense. In variable costing, absorption costing, we both have variable, the revenues. Then you can see here how it's formed, the variable costs. And on absorption costing side, we have the fixed costs included before the gross margin and not included before the contribution margin. Then later on, we have variable period costs included in variable costing before the contribution margin, and in absorption costing, they are included after. I hope that makes that a bit more clear. Okay, let's see, back to this. All right. Yes. So I think maybe to end it off, it will be good to see it in an example, right? So let's in variable costing, you have your sales, boom, boom, boom. Then your second step is your variable costs. Your third step is then your contribution margin. Your fourth step is then your fixed costs. And then the fifth step gives you your net income. Now, of course, sales minus your variable costs. Oh, that was a terrible line. Will give you your sorry about that, there it goes, your contribution margin, and then after you minus these two, then you get your net income. Now for your absorption costing, it's your first step will be your sales as well. Second step will be to minus them from your costs of goods sold. Your third step will give you your gross margin. Your fourth step will give you the period costs. And your sixth step will give you your net income. So first you have your sales minus your cost of goods sold, which you have gotten from here. Then you take your gross margin, again the minusing of these two, and then you take that and minus it from your period costs, and your period costs are your non-manufacturing costs, and these could be like depreciation or indirect materials, indirect labor, utilities, you name it. And then you get your net income. So in summary, the differences is the treatment of the fixed manufacturing costs. The difference is the treatment of the fixed manufacturing cost, absorption costing. They are different than from variable costing. You have your fixed manufacturing overheads included in your costs of good manufactured, and you don't in variable costing. Thank you.